But as you said, John, they actually asked him point blank, what type of landing do you expect, Chair Powell? And everyone's talking about the soft landing. You still thinking soft landing's the default scenario? He basically said no. And he's never going to say, I am likely causing a recession right now. The Fed will never admit to actually causing a recession. But the Fed speak that followed in Powell's answer was basically him saying, hey, folks, I think you better prepare for something materially harder than a soft landing here, right? Welcome to Wealthion. I'm Wealthion founder Adam Taggart. Welcome you here for a bit of a special report. We interviewed Darius Dale yesterday. We normally run part 2 of that interview today, but Jerome Powell, Fed chair, gave a press conference yesterday. Markets today certainly didn't really seem to like what he had to say, so wanted to do a special real-time reaction to the recent Fed presser. So I'm bringing in our endorsed financial partners, New Harbor Financial. I'm joined here by lead senior partners, John Lodra, Mike Preston. Guys, thanks so much for joining us here. A fair amount to react to from what Powell had to say. Like to go through that with you guys, and then we'll talk about what the markets are doing in response. John, why don't we start with you? What were some of the key things that you took away from what you heard Powell say?
Okay, well, thank you, Adam. Great to be with you again, and always things to talk about on Fed Week, pretty much for the last decade at least. But just a couple of takeaways, and this is just news headlines. Probably old news by now, but the Fed decided to stand pat at the current 5.25 to 5.5 target range for the federal funds rate. So no change. The still left on the table the possibility, perhaps likelihood, of one more quarter-point rate increase later this year, maybe at the December meeting or November. And a couple other key takeaways. Talked about a slowing or cooling slightly in the labor market, which has been really a strong, kind of holdout, if you will, in some of the recessionary kind of indicators. We've long said, and you've repeated many times in this program, Adam, that's a classic lagging indicator. So usually when the labor market starts to break, it's already kind of in the early innings of a recession. So that's not one that we really take as a sign that everything's rosy and good. Interestingly, that pretty hawkish tilt to this press release, or this press conference. The expectations is higher for longer. Basically, hey, we're not anywhere close to thinking about lowering rates anytime soon. They did project a terminal rate for the federal funds rate of, I think, 2.5%. I believe late 2025, early 26. I might have the timing on that wrong. They may well get there, but we think it's probably the result of a panic, reactionary move to a market meltdown than a thoughtful, organized, planned path lower. And it'll just be a repeat of the last several episodes of bubble collapses where the Fed had to clean up the mess they made by once again lowering rates in a reactionary way. Interestingly, the commentary on the job market, they communicated an expectation that maybe the unemployment rate will rise modestly from high 3%, so I forget where it is right now, 3.8 or something like that, to 4.1%, which seems massively hopeful to us. That would not at all be kind of consistent with prior episodes of recessions and periods of overvaluations like we've had here. So I think a lot of jawboning, a lot of wishful communication, but the general takeaway is a higher for longer kind of federal funds rate policy, which probably in our minds means that there's going to be a prolonged kind of challenge for the markets and the economy because of the lag effects that still have yet to work through. And Chairman Powell, in fact, did acknowledge that much of the tightening they have done has really not factored into the economy yet. So we're in complete agreement with him on that front. So those are some of the big takeaways, and I'm sure we'll get into some of the market reaction so far to that.
All right. And Mike, I'll come to you in a second. I just want to show a couple of visuals related to what John said. So first, John, you and I, we took the same things away from this. Powell basically said, yep, I'm going to go higher for even longer, right? And I think that higher for longer pretty much now translates into weaker for longer in terms of the economic growth situation. The longer that interest rates stay at these elevated levels, the more time the gravity of those higher interest rates has to act in pulling economic growth down. And Powell, as he's been very consistent about, was just as consistent in this last press conference about how we have not seen the full manifestation of the Fed's activities that it's done to date, both in the hiking regime that it's been pursuing, as well as the in parallel tightening regime with quantitative tightening, reducing its balance sheet. So he's been waving a flag that he's continuing to still wave, saying, hey folks, we really haven't seen yet the main impacts from all the work that we've done so far. So I just take that as saying, expect conditions to get even harder from here than folks have been expecting going into 2024. You talked about the Fed's saying that, hey, we think I think they basically said, and I'll bring up the dot plot here in just a second that they shared, but the Federal Open Markets Committee, their expectation is that they're probably going to do one more rate hike in 2023. Powell isn't absolutely committing to it, nor is he tipping his hand on when he thinks the timing is going to be. But if you look at the current estimates of the group, they are still actually forecasting a Fed funds rate in the 5.5% to 5.75% range right now for this year, meaning that they would need to hike by another quarter point to hit that. Then they come down a little bit in 2024, and you'll see here by this dot plot, they only get down to about 2.5% by 2026 and afterwards. I, like you, think that this is extremely optimistic, unrealistically gentle glide path that they're projecting here. I think it's much more likely that the Fed is forced to cut rates much more aggressively next year, likely due to the sort of something breaks scenario. Under this gravitational force of these high rates, something systemically important is going to break, and/or a recession arises, and the Fed's going to have to step in its time-honored rescue role and have to bring rates down much more aggressively than this. Time will tell. We'll see. We'll keep tracking this. Yep.
Yeah, Mike, I'd like to share a chart because speaking to the Fed pivot kind of track record, if you will, and I think this plays out with my comments just a moment ago. They may well get to 2.5% or lower. Who knows where they end up, but it likely would be because of a reactionary thing. So I'd just like to share a chart here.
Yes.
All right, so this is just a chart. It's only going back to the late 90s, and it shows the federal funds lower limit on the federal funds target rate. You can see right now it's at 5.25, and they stayed at that level yesterday. And in the lower pane is the S&P 500. I've denoted with vertical dashed lines here basically the points in recent history, this century anyways, where the Fed has paused after a pretty notable hiking campaign to only then start to reduce rates. And a couple things you'll see from this chart. First of all, the gray areas are recessions. You have the tech bubble recession here. You get the housing bubble recession. Very brief, ever so brief recession here around the COVID spike in early March of 2020. But what you'll notice here is very shortly after a pause, the Fed almost always drops rates and drops them very quickly. And it's usually in reaction to a market starting to turn over or a economy in recession. Okay, and in fact, this chart doesn't do its justice on the S&P 500. I should have put this on a log chart to show the truth. This is an over 50% drop in the market here. It looks like a pretty benign drop here. This was an over 60% drop in the market in the housing bubble. about a 30, I think 5% drop here in the COVID episode and in March 2020. Bottom line, though, is even despite, so when people talk about the Fed coming to the rescue, lowering rates and everything's going to be peaches and cream again, that usually has very little soothing effect to a market in free fall. In fact, the market continues oftentimes to fall in an accelerated fashion, despite the Fed pulling out all the stops to lower rates. So I do think at some point they will be forced to drive rates lower, but it's probably because they're panicking. And I'll just pull up this chart here. This is a picture of inflation in the late 60s, early 70s, where you had three increasingly problematic spikes in inflation. And I think the Fed is rightfully worried about that episode happening again if they become too accommodative, too stimulative again too quickly after a decade of the most stimulative, accommodative policy in history. They run the risk of some real problems. So long road ahead here, and I think markets will be a battleground in figuring this out.
Those are great charts, John. Yeah, and interesting seeing that sort of roller coaster inflation chart. Just because inflation as measured by CPI is starting to creep back up again. That's got to make Powell and the team at the Fed feel a little bit nervous. I know they were probably expecting it because of base effects and stuff like that, but in parallel with that, with the substantial rise in oil prices here, they've got to be a little bit worried that hey, we're trying to tame this beast, and yet it's still picking itself off the mat here when we really want it to be knocked out at this point in time. We've talked in the past, so I won't spend too much discussion about it here, but we also have this really almost kind of Keystone Cops-esque policy mismatch between what the Fed is trying to pursue on the monetary side, which is really pushing hard on the brakes of the economy. And on the fiscal side, we've still got a lot of stimulus getting pumped into the system by the relatively quite high deficit spending that's going on right now, which is kind of like stamping on the gas from a fiscal side, right? So we've got this our policies on the fiscal monetary side are at odds with each other. They're certainly not coordinated right now, and that's got to be frustrating to the Fed too. Can you do me a favor? Can you pull up the chart one more time again of the Fed's fund rates and the recessions? Because I think it very visually makes the point that I was making earlier, where let's see, we're waiting for it to come up here. Okay, but you can see with each period where the Fed hiked rates and then paused, that's that gravitational effect that I'm talking about, where when rates go up and they stay high, it's just increasing the weight on the economy and it's slowing economic growth. It's that putting on the brakes like I talked about. And what history has shown is it's a relatively crude tool. So what the Fed does is it hikes rates to slow the economy. At some point it says, I don't know, hopefully we've done enough. And then it waits, and then it realizes, oh gosh, we've done more than we thought we intended to do. And then the market starts dropping because the market senses that, okay, there's a recession coming. The economy starts falling into a recession because of that gravitational force for the time it's been pulling the economy down. And then the Fed has to backpedal really quickly. And in each one of these scenarios, you'll see it took a while for the Fed to hike. It then hung out for a while, but the cutting in rates is pretty precipitous. Right. And I think that we'd be, unless there's evidence of something truly being different this time, which I don't think, we really can see right now, it would be folly to assume that the Fed is not going to repeat a similar cycle and instead is going to have this magical multi-year gentle glide path down to 2.5%. So time will tell, and we'll be watching this closely. But certainly, history is very clearly shown by that chart you just pulled up there. John really encourages us to expect a much more violent return to cutting when that gravitational force knocks the economy off the rails, which who knows, a lot of debate going on right now, but could be already sort of in process. Mike, I'm coming to you, I promise, but I got one more chart I want to put up here, and this is the chart of the unemployment rate, which, as you said, John, I kind of laughed when Powell put this up during his press conference. So this is the Fed's expectation of the unemployment rate, and it shows it rising to 4.1% in 2024, basically staying there for a year, then slightly coming down again. We've had the unemployment rate already increase over the past couple months from something like 3.4 or so to 3.8, right? So we're not that far from it already. And if we enter 2024 and, a lot of debate going on whether we're going to have a hard landing or a soft landing or a no landing. But as you said, John, they actually asked him point blank, what type of landing do you expect, Chair Powell? And, everyone's talking about the soft landing. You still thinking soft landing is the default scenario? He basically said no. And he's never going to say, I am likely causing a recession right now. The Fed will never admit to actually causing a recession. But the Fed speak that followed in Powell's answer was basically him saying, hey, folks, I think you better prepare for something materially harder than a soft landing here, right? And if that does happen, we're already seeing the unemployment rate creep up under today's conditions. Okay, I tweeted that chart out after Powell talked about it and said, Fed is predicting an unemployment rate of 4.1% on the average for next year. I said, I will take the over on that bet all day long. Fed has got a terrible track record of predicting, inflation, unemployment, predicting market turns, predicting whether recessions are going to happen or not, predicting what's going to happen in the housing market. I don't think this is any different from its long string of poor predictions that it's made in the past. And like I said to you, John, I just think it's being excessively rosy in the guidance that it's giving us, at least data-wise, both with the unemployment rate, but also with where the Fed funds rate is going to be, and honestly, likely about recession odds. I think it's much higher than the Fed is letting on, even though Powell is being a little bit more generous in opening the kimono with us than most past Fed chairs. So, anyways. Mike, let me hand it to you here. We'll talk in a second about how the market's reacting to all this, but anything else you want to add to what you took away from the Fed's press conference?
Not really, Adam. I think you guys covered the Fed pretty well. It seems like we're all forced to talk about the Fed probably more than we would like to. The Fed has created an environment where it's only what the Fed does that really matters. It's kind of ludicrous in a way, but I think you guys covered it pretty well. I think that both you and John are absolutely right. I think that dot plot is very optimistic. I wouldn't be surprised to see a very sudden market move downward in the S&P at some point soon, and probably next year or later this year, and then of course a reversion to easing very quickly. The chart that John put up there shows that it won't matter. At least historically, it doesn't matter. The market will do what it wants to do, and with the market sitting here at all-time high record valuations still, there's significant risk to downside surprises. So I guess I'd like to just talk a little bit about the market reaction, because the market is what really matters, what the market is actually doing, and just share some charts, just some basic candlestick charts, and go through them. So I'm bringing that up now. You should be able to see in a minute a monthly chart of the S&P. So this is the big picture, the monthly chart of the S&P 500. This goes back 20 years. You can see here what we've been living through, and what I think that we can easily call the largest bubble of our lives, the largest bubble that we'll ever live through. And it could likely be the kind of the termination or culmination of this money printing experiment that we've all been living through since 2009. But I'm starting with the monthly just to give you the big picture. So here we are at around 43.62 as of today. Interestingly, roughly the same place we were about a year ago. And one reason I find that interesting is back in March of 22 is when the Fed started raising rates. So we're about a year and a half past there. And you talked about the lag effect earlier, Adam. There absolutely is a lag effect. With rates going up, they should be moving into or impacting the real economy, but we haven't seen a lot of that yet in financial prices. So the S&P fell, but then for a lot of different reasons this year, including increased liquidity, the market has been on a 45-degree bounce from October of last year. But really, it's only brought us back to where we were when the Fed started raising rates in March of 22. And by the way, we're still not above the high of 48.18 that happened, I think, January 4th of 22. I think that's likely the high for this market, and that this whole thing is a counter trend bear market rally. We can't be sure. We never know for sure, which is why the positions that we have are well hedged. So in terms of the weekly chart, let's take a look at that. It's been a very controlled consolidation over the last year. And as I said, a 45-degree bounce from October. A few weeks ago, we have become concerned, even with all of our concerns about record overvaluation and downside risk, that this giant kind of cup and handle formation was forming. And some of our shorter term indicators reversed into the positive, particularly in the NASDAQ. And so because of it, we made an adjustment to a short hedge that we have in place. We replaced it with an at-the-money put, which essentially allows us to put a stop limit on the risk associated with that hedge. We did that back here. If we had one or two more good solid weeks, we would have broken out from a pretty neat consolidation level. And so we were watching that carefully. We made that change with the hedge. And as it turns out, we're actually breaking down at the moment to a pretty critical level. Nothing is actually confirmed yet. Let me move to the daily chart. On the daily chart of the S&P, you can see a head and shoulders formation forming here. Left shoulder, head, and somewhat of a double right shoulder. And so I've drawn a line in here to show where that trend line likely is. Interestingly, we're bouncing off that trend line. And we are between the 50 and 200-day moving average on an exponential moving average. The simple moving average is pretty close to this. So we were close to breaking out. We were concerned about that. We made some adjustments. Nothing happened in that case. And now we're closer to breaking down, but it's not really confirmed until we see a further move down through this neckline. But this is somewhat of a crash scenario. I mean, if we break and move down harder pretty quickly, this can happen. We could be down to 4,200 very quickly in a matter of a few days. And then from there, the risk is much lower. And so we're strongly concerned. We're very concerned about the S&P. We are very lightly net exposed, and we have lots of cash, essentially about 50% cash equivalents right now with very, very little market risk. And let me just go to the 5-minute for 1 second. You'll see here the Fed meeting yesterday, initially negative, then it took out the previous high, and then it's been straight down from there. I think that, and that's on bonds, but the same thing on S&P. It was negative, then bounced, and then it's been straight down from the Fed meeting. So I want to go to TLT because bonds also had a big reaction, as I just showed there. Here's a daily chart of TLT. It's been a pretty vicious down move, and what I think is likely a capitulatory move here after the Fed. I mean, we talked about the dot plot a little while earlier. The Fed's probably going to get down to 2 to 3% target rate, probably a lot sooner than the market thinks. Those rates going down will push bond prices up, and by some estimates, the Fed has $2 trillion of losses on their books with these falling bond prices. In my mind, it's only a matter of time before something happens, and including things like potential yield curve control, where they buy the long end of the curve, and an S&P market drop with speed and velocity should cause money to come into long-term bonds. Now, I'd be remiss in saying that we've got some very strong hedges on our TLT position as well. Essentially, half of our position is off the table because we have puts in place at 98. The other half, we're pretty religiously selling calls against it, and we're pulling in income. That position is still down, obviously, but we're working like crazy to try to manage it and hedge it properly. Those are the two lines here that we have. Our 98 puts are right here. So if I can just show a monthly chart, go back to that, because I want to compare that to where the Fed started hiking rates in March of 22. That was back here at 130, 135 on TLT. So you can see bonds have been hammered over the period of time since the Fed started raising rates, and yet stocks have hardly moved. So that's the question: who's lying, and who's correct? I think the S&P is lying. I think the S&P is being teed up for a big drop here. And I think that long-term bonds will bounce. It's been difficult to hold on to that position, but we're doing the best we can with option hedges. And I think that ultimately long-term bonds bounce, probably come back up to here, 110, 120, or even higher on TLT, as the Fed does have to revert to easing much sooner than expected. So lastly, I think that I would just say one or two things about gold, and then I'll stop. Still, one of the best looking charts out there is gold. This is the 20-year monthly chart, giant consolidation. And over the last 5 months, it's been really frustrating for gold investors, but it's forming this little handle-like consolidation. The big question mark here, like it was with the S&P, is where's it going to go next? I believe we're going to break out. We're going to pierce this triple top and move into the $2,500 range. And that's probably going to happen next year. I'd like to say later this year, but I don't know when this is going to break out to the upside, but the projection would be to around 2,500. Short term, on the daily chart, gold really hasn't moved too much since the Fed decision. It's been all about stocks gapping down and bonds gapping down since the Fed decision. But I would bet on bonds at this point a lot more than I'd bet on stocks. I'll pause there.
Okay, and all right, so this is where things start to get really interesting. And thanks for confirming for viewers that you guys are not losing confidence in your treasury trade and your TLT trade.
No, we're working it like crazy, but not losing confidence in it.
Okay, so a number of folks that I've interviewed on this channel recently, Darius being one of them, Lance Roberts being another one, and Sven Henrik, all of them say, hey, look, this is all prior to yesterday's Fed presser, by the way, but really, Powell didn't even raise rates, right? He just was more hawkish in his outlook. But they basically, they all, I think, share your guys' general opinion that a recession lies ahead in 2024 at some point, and the Fed's going to be forced to pivot and whatnot, right? But they've been looking at the market activity and saying, hey, there's still been room for stocks to run, and that certainly has been what's happened so far this year. And they're all pretty much saying to people who are really bearish about what may likely happen in the coming future, saying that very well may happen, but you could still have a pretty big run up in stocks beforehand. Lance has basically said, look, the market has traded much more on technicals this year versus fundamentals, and the technicals have still been pretty bullish. We haven't broken through too many technical warning barriers yet. Now, the past couple of days have brought the S&P down below the 50-day moving average. So it's punctured through one of them, but there's it hasn't broken through key support yet, right? So he's basically saying he's not going to change what he's doing until he sees those support levels break. Sven says pretty much exactly the same thing, just with a ton more charts. I think you guys watched his video from last week. He basically said, look, I hate to say this, but I'm very bullish fundamentally, but I got to bearish fundamentally, but I got to be bullish on the technicals until at some point they change. And he brought up that chart of the past 20 years average of the S&P. It's just a seasonality chart. And he says, look, I normally don't trade off of this, but he said the market's been following this script all year. And if that continues, it shows that we should expect stocks to kind of run up through the end of the year, pretty much from here on out. And again, Sven is saying, look, there's no guarantee it's going to, but this is just the trajectory it's been following. So as long as this correlation holds, we have to hold ourselves open to the fact that this may happen. Darius has a very similar point of view. And one of the things that he mentioned is he showed how stocks tend to actually outperform in years prior to a recession. So, sort of they party hard and they sort of slam into the recession, and then they have those big corrections that John was showing earlier on. And what he said is you get of that outperforming year, over 50% of that return comes in the last 3 months before the recession. So it's like the party just gets wilder and wilder until the cops arise. right? So cops arrive. So, he's saying, look, who knows if this is exactly what's going to happen, but if we indeed think that there is a recession coming at some point next year, Darius pegs it at around the beginning of Q2 next year. And he's saying, folks, that just be aware, there's potential that stocks could actually run pretty hard up until, the beginning of next year, right? Not saying it's necessarily going to happen. They're obviously selling off right now in the short term based on what Powell said. But like I said, this is where it gets interesting, right? Whereas a capital manager and an investor, you get to try to pick what you're going to play for. Do you think, do you think stocks are falling off right now? Is this the start of it? And Mike, you showed some charts and said, hey, maybe this could be the beginning of something. And certainly we can come up with a zillion arguments why that fundamentally should be the case. Or do you look at more sort of the technical side of things, what history has said in other situations like this, and say, hey, I don't know, maybe I got to put give some mindset to the fact that stocks may continue to run up from here. And if so, what do you want to do? Do you want to try to play that? Or do you just want to sort of sit on the sidelines and see, and then when it becomes a little bit clearer, make your decision, right? But this is where it gets interesting. And same thing on bonds. Darius thinks that bonds will do well when the recession hits and the Fed pivots, but he thinks that they are more than, in his estimation, more than likely, as if stocks do surge for the next couple months here or whatever, that bonds could go further down. And he actually pegs his 10-year target right now, I think, was 4.75%. So, we're getting close to that. We're getting close to 4.5% on today, but he thinks he could tack another quarter point onto that. We'll see what happens. But again, like I said, this is where it's beginning to get really interesting, where you can get smart people looking at the same data and making different predictions on it. And you as an investor or a capital manager have to determine how you want to surf that. John, you're nodding a lot as I'm saying this. Would love to get your reaction.
Yeah, so all this investing really is about probabilities. I hope none of the viewers take from us, or maybe even your other commentators, that it's a binary type of view that we have. It's all about probabilities. So, for example, yes, we have had a longer duration Treasury position for recent months over the last year or so. But it's only been at most 15% allocation. But absolutely have not been of the mind that longer-term bonds were a hand over fist, steal of the century. They're getting more attractive, but our position only was about 15%. In fact, we've been leaning much more heavily on the short end of the curve, short-term Treasury bills, 3-month kind of thing. In recent weeks, we've extended that out to 6 and kind of 12-month type of thing. And Mike talked about us having a little over 50% cash. When he says that, what we really have is short-term Treasury bills. The last couple of tranches we did were yielding annual yields just shy of 5.5%. They've actually spiked up a little bit since then. So it's all about proper positioning. Just a quick comment on the election cycle, cyclicality data that gets thrown out quite a bit. Yeah, there is cyclicality there that is somewhat regular, but the problem with those kinds of things is they, in averaging out and coming up with those average cycles, you lose a lot of texture and nuance that you only have to have one outlier to make those averages and those cycles be rather irrelevant. I may be doing my math wrong, but I think 87 was a year that preceded an election year. And in October of 87, you had the crash of 87. Not saying that that's necessarily what we see this October, but those rules of thumb, those cyclicality averages, you can lose a lot of context. And 87 saw a over 20% drop in the market in one day after a pretty bloody week the week before. And that was from valuation levels that were less than half on a Shiller PE basis than we're at now. So got to be very careful about using some of those things. And in terms of the bigger picture of interest rates, 10-year treasuries did, and I'll just share a longer term chart for perspective here. Let's see here. This is a long-term chart of 10-year treasury yields. So we're just today, we got just shy of 4.5%. I think we're probably near the end in this spike higher. Maybe we challenge the 5% that we saw back in prior to the housing bubble. But even still, if you take TLT, for example, it's got a duration of about 17 years. If we had about a 0.5% move higher in the 10-year yield, simple math, we're talking maybe about an 8 to 10% decline in something like TLT. So it's not like there's this major further bond collapse likely to happen. Doesn't mean we can't see further weakness. TLT is just above 90 right now, 91 and change, I think. Maybe we see high 80s, maybe mid 80s, but our position, as Mike already said, is about half of what it was. It's about 7.5% position, and we're renewing hedges on that. So we don't have any concerns about that with the position size and our strategy. But what we do have is lots of dry powder that's very safe in the form of treasury bonds, treasury bills, I'm sorry, that we can in a moment sell and deploy into other things like stocks or bonds at better prices.
Great. And if I can just note here, if you go back right before the recession of 2008, where the previous kind of high there, I think the federal debt was around $10 trillion.
Yeah.
What's it now, John? It's like over 33 trillion, right?
Oh, it's a whole different ballgame, courtesy of the money printer over the last decade. Absolutely.
Right. And this is when I talk about that gravitational effect, it's so much stronger now, even though we're at we're nearing the same federal funds rate. The effect of that federal funds rate is so much stronger now just because we have so much more debt in the system. All right. Well, guys, great discussion here. One thing I want to note about something that Powell didn't say, something that he said and he didn't say. He kept talking about the Fed's mandate is to pursue price stability, and really of its dual mandate, the price stability one really is the more important one of them. And he said, look, folks, we get it. We get that there are households that are really impacted when price stability isn't maintained, and that's a fancy way of saying that when the cost of living goes up, inflation causes the cost of living to go up. Regular households get hurt by it. But what's so interesting is he did not acknowledge any role that the Fed played in contributing to the spike in inflation. Right? It just basically talks about it like it's this act of God that kind of came out of nowhere. So he doesn't address the Fed's own culpability in it. And all right, should we really expect him to do that? Probably not. Just because it's admitting fault, and no major government entity is going to willingly do that. But what he also didn't do is apologize in any way for this. Right? There's no sense of like, hey, average American, I'm really sorry that you're suffering for the shockwaves and the repercussions of bad decisions that we made in the past. Right? Again, maybe not something that he's going to say, but it does just sort of, it's infuriating for folks. I don't want to speak for you guys, but I believe you're like me, where the Fed is sort of trying to paint itself here as, golly gee, doing its best to rescue all of us from this unfortunate inflation that's sort of magically come out of nowhere, when of course it's a direct effect from policies that the Fed and the federal government have been jointly pursuing. I see both you guys nodding on this. I'll let you guys make any commentary you want on that. Let me just note it based on consumer households. We are finally beginning to see some real data. I know we've been tracking lots of data points all year that have been suggesting that consumer households are increasingly, beginning to strain under the high cost of living. But now a lot of institutional research houses are coming out with increasing warnings about the weakening consumer household. JP Morgan just came out with a report where they basically warned about seeing increased weakness in the consumer because of longer-term impact of inflation and higher for longer rates. This is pretty much the lag effect that we've been warning about. Student debt going back into repayment, and consumer personal savings depletion. We talked about the pig and the python. It seems like from a personal savings side of things, the pig is pretty much fully out of the python at this point in time, and consumers have gone from surplus to deficit. And that's obviously been very supported by the huge increase that we've seen in consumer revolving debt balances, where people are increasingly funding more and more in their lifestyle, on the plastic credit card. In addition to JP Morgan, Goldman Sachs just came out, basically said something quite similar, but they said that the things that they're watching is the focus on higher oil prices and how that is crimping consumer budgets, the student debt resumption, like we talked about, and then credit card data is showing that there's softer spending on consumers following the back to school period. So we got a little bit of a juice to the economy because of back to school, but the spending after that has been weaker than seasonally normally suggests. So these are signs that the consumer is increasingly tapping out here, right? So we'll keep watching all of this, but yeah, Powell, you should be mindful of the impact of price instability on consumer households, because real people suffer from this, and the data is showing that they are increasingly starting to suffer, noticeably from here. And of course, as consumer spending goes down, our GDP is 70% consumer spending. That, basically is some of that increasing gravity that I'm talking about that's going to be slowing economic growth. And if that then causes corporate budgets to pinch enough that they have to start laying people off, then we get into that vicious cycle. And we talked about how we think the 4.1% unemployment projection by the Fed is unrealistic. I mean, that number just completely goes out the window if we get a true recession with substantive layoffs accompanying it. So, guys, I'll hand you the baton to give any parting bits of advice here. Mike, why don't we start with you?
Yeah, it's maddening, isn't it? The Fed talks about price stability, yet they've caused, I think, the largest bubble we'll ever see. I was reading a piece that Charles Hugh Smith wrote the other day, and he estimates that $55 trillion in excess wealth in quotation marks, has been created since the 2009 financial crisis in this country alone due to the excess money printing. And most of that, greater than 90% of that, went to 10% of the people. And most of that, to the top 1%. So that hasn't been fair. That's causing some social, I think some societal problems, or certainly will, going forward. And the Fed says they want price stability, but a lot of people can't afford homes these days. I saw a different chart that showed what a $1,000 mortgage payment could purchase in terms of a house, and it was something like 270,000 has gone down to like 150,000 or so. I wish I had that chart at my fingertips, but suffice it to say, the amount of house that you could buy with $1,000 mortgage payment has nearly been cut in half. And yet housing still remains aloft. It's pretty much a marvel how long this bubble goes on and on and on, both in the S&P and in housing. And that is the financial markets and in housing. It won't go on forever. We've trusted these people. They have, I think, taken it too far. They say they want price stability, and yet we don't really have it. They said they wanted 2% inflation for years, and that's while we were at 0% interest rates. Then all of a sudden, inflation went from near 0 to 9%, and now it's trending back into the 4s. But honestly, there is no plan B here. It's always been, for the last 15 years, more and more stimulus, and it will be that way again. I think soon, when this market falls, it'll be more stimulus. This time, I don't think the market will react positively, and I think it could be worse than a lot of people think, and I think it could stay down a lot longer than people think. More of an L-shaped move than a V-shaped move. So let's see what happens, but those are my thoughts as we wrap up.
All right, good wrap-up thoughts. Real quick as we land the plane here. First off, I want to remind folks that tickets are still available at the early bird price for the Wealthion Fall Online Conference that's coming up on Saturday, October 21st. I haven't said this as much as I should, but if you can't watch live on that actual date, don't worry. Everybody who registers for the conference will be sent replay videos of the entire event, all the presentations, all the live Q&A afterwards. So don't worry if you can't watch the entire thing on the actual day of. You'll get those videos you can watch at your heart's content. I won't go through the amazing faculty that we have there, because you can find all that and how to register for the event over at wealthion.com/conference. It is our best faculty lineup ever. And I do just want to note that I just got confirmation from Jeff Clark that he will be recording, as he has for the previous two conferences, a bonus video that goes through his latest precious metals mining stock picks. As we've talked about in past videos, guys, that complex is being run much better than it was a decade ago, and the prospects for the underlying metals in some cases are as strong as they've ever been. And you gave a quick nod to this a few minutes ago, Mike, but the miners have really been lagging. And so this could potentially be an extraordinarily good time to invest in the space. Brian London, who I had in the channel last week, said that he thinks that this is kind of a generational opportunity. So very glad to say that Jeff's going to be recording that video, going through his top stock picks, sharing the companies, explaining what about them attracts his attention, and obviously sharing things like tickers and whatnot that investors can go off and go check. So definitely go register for that conference to lock in the early bird price. And if you're an alumnus, of our previous conferences, check your email inbox. You should have a discount code from me that'll give you an additional 15% discount off of the early bird 30% discount. If you enjoy these sort of special reports that we do in response to breaking developments in the economy, in the financial markets, please vote your support for us to do more of these by hitting the like button, then clicking on the red subscribe button below, as well as that little bell icon right next to it. And obviously, as we talk about every week, there is a lot going on. Like I said, it's getting really interesting now, where smart people are looking at the same data and coming to different conclusions. These can be very difficult times for the average investor to navigate. Most folks just are trying to figure out what's going on, but most importantly, they're trying to live their lives. They're trying to focus on their jobs, take care of their families. They don't necessarily have the experience, the expertise, or just the time and bandwidth in their lives to really be glued to the markets and really trying to, in real time, tweak their strategies and their allocations. So that's why we highly recommend that you work under the guidance of a good professional financial advisor, especially one that takes into account all of the issues that we've been talking about here in this video today and on this channel in the past weeks. If you've got a good one who's doing that for you, great, stick with them. But if you don't, consider scheduling a free consultation with one of the financial advisors that Wealthion endorses, maybe even John and Mike themselves and their team there at New Harbor Financial. To do that, just go to Wealthion.com, fill out the short form there. Only takes a couple of seconds. Doesn't cost you anything to have these consultations. There's no commitment to work with these guys. These advisors just offer it as a free public service to help as many people position as prudently as possible in advance of what might be coming down the road. John, I'm going to let you have the last word here as we walk folks out.
Always great to be with you, Adam. Things are moving quickly here. We're always watching markets, but we also, our clients have real lives, and much of the conversations we have with them have to do with things that are related, at least somewhat tangentially, to their investment assets, but it's so much broader. For example, we have the opportunity to have a conversation this week with a group of professionals about end of life planning and things like that. Mike and I are CFPs, certified financial planners, as is Michelle on our team. Justin Griffin practices this kind of stuff every day as well. So we have the opportunity to kind of have a actionable seminar or conversation, if you will, on this topic. And I'm actually many of our team members are dealing with these kinds of things personally, being in the sandwich generation this week. Had some issues with my mom's health situation, and my mother-in-law's got some terminal diagnosis. So we're living this stuff as people, and we know how hard these kinds of things can be for our clients, and we're here to talk about and counsel them through these kinds of things as well, not just talking markets and price movements. It's a bigger picture. It's about life.
Thanks for that reminder, right? It's not just about what stocks are doing. It's about all of the aspects of somebody's life. Well, let me just say first and foremost, from myself and from the viewers, John, best wishes to you and the seniors in your family, and in handling all this transition as best you guys are all able to.
Thank you very much, Adam.
All right. Well, look, as we wrap it up here, guys, thanks for a great week, great discussion. Mike, you were talking about housing. I just want to flag for folks, we had an exceptionally good interview last week with housing analyst Melody Wright. The feedback of that video has been tremendous, and I just flag it here because basically Melody, her main conclusion there is the headlines and the data that we're hearing about the U.S. housing market are actually much worse than what we're being told. And in many cases, it's due not necessarily to intentional deception. It's just that there's a lot of flawed and faulty data that even the real estate professionals themselves are using to draw conclusions. It's a great interview. Melody has done real boots on the ground analysis. She's actually gone and visited a number of the hottest, or at least formerly hottest, real estate markets in the country: the Austins, the Phoenixes, the Las Vegases, the Nashvilles, the Miamis. And a lot of her findings are really nothing short of shocking. So folks, if anyone's interested in learning more about what's truly going on in the real estate market, at the end of this video, I'll put up a link to that interview with Melody. Thanks so much, guys. Great week. Everyone else, thanks so much for watching.
Thank you, Adam. We'll see you soon.
If you'd like to schedule a consultation with one of the financial advisors at New Harbor Financial, simply go to Wealthion.com. These consultations are completely free, and there are no strings attached. The good folks at New Harbor will simply answer any questions you have about your investment goals or your portfolio and give you their best advice given their latest market outlook. They're willing to do this because they care about protecting people's wealth, and because Wealthion has connected them with so many thoughtful investors just like you over the past decade. We started doing this because so many people have approached us in frustration, looking for a solution because they're feeling out of alignment or downright ridiculed by the standard financial advisors who have been managing their money. You know the type. The kind that just pushes all of your money into the market, scoffs at the idea of owning gold, and when you bring up concerns about the market's sky-high valuations, they say, "Don't worry, the market will always take care of you." For many of the reasons discussed in today's video, we think this is one of the most challenging and treacherous times in history for investing. We strongly believe that today's investors are best served working in partnership with a conscientious professional financial advisor who understands the risks in play. Now, we're agnostic which professional advisor you work with, as long as they're good. If you're already working with one, that's fantastic. Stick with them. But if you don't, or are having trouble finding one you respect or trust, then consider talking to John and Mike and the team at New Harbor. Now, for those about to ask, yes, there's a business relationship between Wealthion and New Harbor, which we've put in place to make sure everything is handled according to SEC regulations. All the details on this are clearly provided on the Wealthion.com website. Also, it's important to note that New Harbor is able to work with U.S. citizens, green card holders, and those with existing assets in the USA. But for regulatory reasons, they aren't able to take on non-U.S. clients. All right, with all that said, if you'd like some insight and guidance on how to protect your wealth during this unprecedented time in the markets, go to Wealthion.com to schedule your free consultation with the good folks at New Harbor. Thanks for watching.